Welcome back to Benjamins with Ben. This is going to be the second video that I've ever posted to the channel, and it is going to cover why you can't afford not to invest. Oftentimes when I ask people why they don't invest, I get the same answers over and over again. It seems too risky, they don't want to lose money, they don't know enough to feel comfortable, they don't know how to open an account, and then number 5 is they just don't know what to invest in. And I touch on that a little bit. When we think about risk, a lot of times with investing, we're thinking about if I invest $100 into a stock, it goes to zero. That seems pretty risky to me. It's almost like gambling. Investing for the short term, especially when you're investing in single stocks, is pretty much like gambling in terms of the probability of you making money on a single trade. Like if you were to buy a share of Tesla or buy 1,000 shares of Tesla, the odds that it would make money might not be so good. You might be able to better gauge that risk based on the knowledge that you have around Tesla and might see that as a way to invest to make money in the short term. Good investing is about investing over the long term. You're not investing for yourself tomorrow, you're investing for yourself in 20 years. It's particularly hard to have that conversation with people who are young, because I'm like this sometimes too, where I'm more concerned about how much I can spend when I go out on a weekend versus how much I can spend in retirement. I'm not really thinking about Ben in retirement. Unfortunately, we tend to not pay very much attention to the person that will be in 30 years. We think of it almost like a completely different person. It's still important to plan for that person and make sure that you're not only living your life to the fullest now, but that you're also enabling yourself to live life to the fullest as you get older. But I'm going to throw up a chart right here, and this chart is going to show what would happen if you were to invest $1,000 a month over 30 years, and then what would happen if you invested the same amount, $1,000 a month for 30 years. But because it's invested, you're getting a return. So if we look at Bill is a person who paid exactly the same amount as Kathy throughout his entire life, but he never invests. So you get to the end of the 30 years and you've been putting away $1,000 a month, which is not a small amount of money. It's no small feat. And he's been doing that over the course of his career. You look at Kathy, who's been doing the same thing, $1,000 a month. Again, not an insignificant amount of money, but has been doing that consistently and investing it consistently into broad market index funds and ETFs over the same 30 years. And with that same amount of principal being the amount of money that they're putting into their accounts, you can see that Kathy is by far and away more wealthy than Bill. So I created this chart on my own, but we're going to go a little bit deeper here. We're going to take a look at the investment calculator offered by calculator.net. So if you type in investment calculator to Google, it should be the first non-ad option here. You can basically play around with this, and you can play around with the starting amount. You could say, okay, well, maybe I'm early in my career, so I've got $10,000 of cash. You can see what would happen after 10 years, after a different return rate. Let's use 7%. That is assuming a 6.5%. And that 6.5% is what the total stock market indices have returned over the last 90 or so years. So we're going to put in 6.5. We're going to compound annually. You can also compound continuously, daily, weekly. If you have $100, every time this compounds, it's like you're getting $6.50 added to whatever that starting amount was. And so if you're compounding it annually, you're adding $6.50 to the $100 every year. So we're doing that with $10,000. So let's just see what would happen if we just started with $10,000 over 10 years, 6.5% return. What happens? So that $10,000 will grow into almost $20,000, exactly $18,771 over just 10 years. And that's assuming a pretty, moderate return. Let's take a look at it over 30 years and see what happens. Drastically different. So triple the time and more than triple the money in our account, just from a static balance, right? We're not even adding money. So now let's take a look and see what would happen if we were to put in $1,000 at the end of each month. So same idea, starting with $10,000 over 30 years, 6.5% rate of return, compounded annually, $1,000 additionally every month. You're gonna end up with 1.13 million. So they do a really good job with this because you can really easily see where your balance is, your total balance, how much interest there is being made off those investments versus what the starting amount is. So this is your principal. And this is the same, just throwing it in a checking account over that time span. So you can see you'll have maybe around 400K, total contributions, 360K at the end of those 30 years. And then if you look at this line, you can see that around the 20-year mark, the amount of interest off of these investments actually elapse your principal contributions. And then if you add them together, you get this green line. So you're going to end up with 1.13 million after 30 years. And again, that's just assuming it's just $1,000 a month every month for 30 years. Not terribly complicated. This is assuming start with $10,000. You're not getting raises. You're not getting promotions. You're not switching companies. You're not making more money, basically. So there's no additional capacity to invest more at all, ever. So this is the big thing for me that really convinced me that I needed to start investing. Another thing about risk is depending on your goals and age, your risk tolerance might be a little different. For example, if you have a family, it may be better to opt for a lower risk approach. The same applies if most of your wages go to living or cost of living, food, and other fixed expenses. So typically, if you're younger, you're a little more risk tolerant. As you get closer to retirement age though, you want less and less variation in the balance in your accounts because you want that to be stable for retirement and you want to be able to pull from that. One of the ways to hedge risk is to diversify into a variety of different industries through something like an ETF. We're going to cover a couple of key terms that are a little tricky to understand. So there's two things that everyone should know when it comes to investing. One is capital gains and capital losses. So if you bought a share of Apple for $100 and it went up $10, your capital gains $10. If it were to go down $10, your capital loss would be $10. And you don't realize those gains or losses until you sell the security. So if you don't sell the security, they won't be realized. Doesn't mean it hasn't happened. It just means legally you don't have to pay any taxes and you can't take a write-off. Volatility is another key term that can be really helpful. It took me a little bit to understand, but basically volatility is a measure of how fast a stock, bond, security changes price over time. So if it has these massive swings up and these massive swings down, generally that's going to be high volatility. If it just kind of goes like this or goes flat, maybe goes up a little bit, goes down a little bit, it's going to be low volatility. Typically, high volatility is associated with higher risk and lower volatility is associated with lower risk. So back to the retirement example, we really don't want to be going into retirement with our portfolio going like this. We want it to be more like this, ideally going up pretty steadily. If you want to hear more content, please consider subscribing, liking, turning on the notification bell, and clicking the link below to check out the blog and subscribe to the newsletter.